Hello Silk Trades, this is 13 with another video. Today is a beautiful morning. It is Tuesday. We are gonna go over one of my favorite strategies. It's gonna be playing credit spreads in options. It's the strategy I make most of my income from. It's what keeps me going and keeps the money flowing. Let's look into it right now. So right here, this is the entry I got into. I got into an Apple 220 217.5 puts credit. That's basically going to be the exact opposite of getting into a naked call or naked puts. If you get puts, it basically means you're bullish. When you get calls, it means you're bearish. So it's pretty bullish on Apple. Definitely hitting a bottom today and going back up. Looking into it, I also got into the October 19th expiration date for 62 credit. Sorry if I sound a little stuffy, I'm a little sick this morning. Let's look at some options so you can better understand how I got into this. So when looking into options, let's say, I am bullish on Apple. So you're going to be looking for a price that you don't think Apple will go to. So I don't think it's going to go down to 220 by October 19. Uh, so I got into that contract right here. Always look at open interest and volume. Once again, stressing the fact that you don't want to have a huge spread on this. You want to make sure you can get a good credit. Uh, as you get into that for your sell, make sure you sell put that. Uh, Going the opposite way too. Let's say I was bearish on Apple, you'd want to get something that you think Apple would not reach. So I don't think Apple will reach 235 by October 19. So I'd get into that. Uh, that's the first contract you need to buy, first off. The second one's going to be a little bit more out of the money. OTM is going to be out here, so it's going to be farther out. So this is going to be basically a cushion, and it's also going to be the determining factor of how much money you're going to make and also how much money you're willing to lose. For all pretenses, let's say I put that there at 240. There's enough open interest. Definitely not going to be risky trying to get rid of it. So this would be the bearish spread. Okay, so you're doing a 235, 240 call spread. That is going to be a 5 point difference. When you hear the word point, it basically means a point, basically a dollar on the stock. So that's a $500 point difference. So you're risking $500 for a total credit of $54. So to better understand exactly the math and how to calculate risk, let's say we're going into this, right? So 235, 240, that's a 5 point spread, so that's $500. The total credit, if we did get this, obviously I'm not going to get it because Apple's going to go up, 53. So you're going to want to do 500 minus 53. This is the max amount of money you can lose off a trade like this. So you're going to be losing $447 if Apple goes above 235. So you really want to make sure that you're looking at that risk and you're making sure that you're following your own risk and your own play. Let's get back into the play I made though. So right here, I got into 220 because I believed it wouldn't get there. Good open interest. And then you're going to want to buy right here. So I was saying I only wanted to risk 250. Yeah. I only wanted to risk 250 on this play. I got a credit spread of $62. So ideally, when I look for these plays, I want to make sure I'm getting paid at least $50 on these. So we're gonna do 250 minus 62 credit spread. That's the max profit you can make is your credit. So I'm risking $188 to make $62. And a lot of people are probably wondering at this point, why on earth would you want to risk $188 to only make a measly $62? Well, let me explain that to you in a better graph. As we're looking at the graph right now, Apple is at 226.51. I definitely made a lot more fucking money on this play as time went on. Let's look into it right now. Let's look at when I bought into it to give you guys a better understanding. Let me actually get this in a better light. This is probably good right here. So I got in around 10 a.m. Okay. Technical readings, it's above the 50 SMA, it's on the upper band. A lot of volume was coming in when the contracts were being shown. Good volume right here to show this uptrend. I didn't get in at this time, obviously, because it's the opening bell. I wanted to wait to see if there was any type of different trend or if it was just going to be another bull trap in the morning. Uh, Turns out it wasn't. So as it was going down, I figured this is where I would want to buy, but I didn't because obviously it's on the lower band. It just went under the 50 SMA. I don't know if it's going to start falling way under. As it went back up, this is when I was getting more serious about it, and this is where I decided to purchase my spread. Uh, this is basically going to be the point of your profit. Okay, so right here, as long as your contracts by October 19, as long as they don't go under this, you will be making your money. You will be making a lot of money. You can make all of that 62 if you hold into expiration because it won't be under this and those options will expire worthless that you just sold to someone. So keep that in mind. So this is so this is where I felt comfortable taking that risk. We got into the 220s, so that's a 6 point spread that we're working with. That's a little wiggle room we have to make sure we don't lose any money. Basically, anything from 220, which would be, it's not even on the chart. That's how low of a risk it is. So 220, if it hits that, we lose money. If it doesn't, we're still prone to losing money in this area, but not as much as the 188. That is the max loss. As long as it's going up, we profit. And the nice thing about this play is you have a 66% chance of being profitable. Okay, so we're right here, right? When you're trading options and you trade a naked call or a naked put, you are essentially saying, hey, I know which way it's going to go, and I know for a fact it's going to go that way. To play it safe, when you get a credit spread, you're not saying exactly, oh, I know it's going up. You are saying that, but you're playing it two ways. You're also playing the fact that it's not going to go under this price. It's not going to go to 220. So as you play an option spread, you also play uh, time decay. So theta is a weakness when you trade options. When you trade it with credit spreads, it becomes your strength. So let's say I got in right here, right? Let's say you know 5 days later, it's still the same price. It's right here. You would still make money even if the price has not moved whatsoever. So that's why I love trading this. There's 66% chance you're going to be profitable. Uh, Now, I'm not saying this is a for sure win, but as long as you do your research, you understand the company, there should be no reason that you don't profit off this or you at least make a good strategy going into this. It's exactly why when you're looking at it, you're risking $188 for us. Let's see what this is right now. So now the spread is 44. I got in at 62. So right now I am making $18 off of something that is minimal risk, and I will probably make the rest of that $44 within a week's time. Uh, this is as simple as it gets. If you have any questions on it, please let me know. Uh, just for terminology and to go over things again, this play right here is a bull put spread. Let's say you got this play that we were talking about beforehand. Let's say you got into 235 sell call and then a buy call up above for like 5, let's say right there. You'd get a credit of 57 and this would be considered a bear call spread. Okay? Now, I'm going to recap everything so it's nice and clean so you can look back at this if you don't understand it. So let's go over it. What do we have right here? We have a bear call spread. What are the points? 235, 240. That's going to be a 5 point difference. So that's going to be $500. Keep in mind as well, it's very important you remember to do this. Your sell has to be closer to the current strike price, and your buy has to be farther out of the money so you can get that net profit. You're selling this, you're making $79. you're buying this contract, so you're buying $21 worth of that contract. So keep that in mind. As we're looking at this, 58 is going to be the profit we're making. So on this play, you're risking $442 to make 58 bucks. Obviously, this play is garbage. It's because Apple's going up right now. If we look at this, there's no way you can probably fill in on this and make just as good as money as I have been making. Uh, let's see. Oh yeah, don't want to do an iron condor. We'll go over that in the future. Just to reiterate exactly what play I'm in. Now it's 42, so I made an extra $2 while I was showing that little demonstration. Uh, if you have any questions on it, please ask me in the trade-in group. I'm always available in the morning times, during power hour. The only times I'm not available is in the afternoon when I'm making these videos or I'm busy talking to clients. So keep that in mind. We are probably going to go over some other option strategies, but I figured I'd go over this one first with you guys. This is probably going to be my most favorite strategy to show. It's pretty successful. It's what I use to make a living off of trading. Uh, Obviously, this account is a little bit smaller, so that's why I only got one of these contracts. But with this play, I consistently make about $500 to $1,000 every 2 weeks, and uh, along with my regular option trading as well as the shares that I own, this is usually enough to make a healthy living off of. So I'm about to sign off. Just made an extra dollar on that contract. If you have any questions, feel free to ask me in chat. The Discord link will be in the description. Feel free to subscribe, comment anything that I might have missed, okay? Alright, have a great day.